Good afternoon, everybody. Thank you very much for joining us. This is Andy Umbach. I'm a financial advisor here at Pulse Financial Services, and I welcome you all to the fourth quarter of Guide to the Markets. It's crazy. We're already in the fourth quarter here of 2025. It seems like everything just keeps going quicker and quicker. So we're going to go over 10 different points in 10 different slides and hopefully 10 minutes. So the ride. So as you can see here, the economy, has slowed down and sped up and slowed down again over the last year. The collective impact of tariffs, tariff uncertainty, federal government cutbacks, declining immigration appear to be slowing the U.S. economy, although most of the negative effects should be delayed until the fourth quarter or so. Looking past the swings in imports and inventories, we expect real final sales of domestic products to rise from 1.9 annualized growth in the first half to about 2.5% in the third quarter, but then maybe slide to less than 1% growth in the fourth quarter. However, passage of the One Big Beautiful Bill Act, the new tax law, should probably inject some nice stimulus into the economy in the early part of 2026 via strong income tax refunds. People would be getting more money on their tax refunds, which is a form of stimulus. And this should boost economic activity in the first half of 2026 and hopefully overcome some of the potential price increases on these tariffs. Thereafter, we expect growth to kind of slow perhaps in the second half of 2026 as the refund effects fade and the effects of higher tariffs and lower immigration continue to linger. Lower immigration should limit the increased unemployment caused by the slower economy. A slower growing U.S. economy will mean slower job growth, with average monthly payroll gains potentially falling below 50,000 for the rest of 2025 before reaccelerating slightly into 2026. However, the impact of slow job growth on the unemployment rate should be suppressed by a sharp decline in immigration. Illegal immigration has fallen to almost zero, and deportations have increased back to levels similar to under Obama. Data, though, may also suggest a decline in new immigrant visas issued. Data on both deportations and legal immigrations are very spotty, but overall, we believe that net immigration could fall to less than 250,000 per year, down from an average over 1 million per year for the last 2 decades, even before the pandemic. And that implies, a flat or declining labor force, limiting the increase in unemployment rates to just around 4.5% by the fourth quarter of this year, and then holding at that level into 2026. We expect wage growth will remain steady as recession worries counteract tighter labor markets and wage negotiations. The positive effect of the lower immigration, we should see wage growth increase amongst the lower earners, though, and that should help also close some of the great wealth divide that's been happening for decades now. Inflation could potentially rise over the next year due to some of these tariffs and the fiscal stimulus, but fall later into 2026. The impact of tariffs on inflation is beginning to be felt, with year-over-year CPI inflation rising to around 2.9% in August. As you can see, it's down substantially from its peak back in June of 2022. But we believe the tariff impacts on inflation could increase in the coming months because a lot of the companies were doing what's called front running some of the impending tariffs. So they were buying a bunch of their inventory at lower cost before the tariffs went into effect. And now they're using up that inventory, and now there could potentially be some higher prices passed on. Of course, all along the pipeline, people participate in these increase in tariffs, and so hopefully the end consumer is not as impacted by the full effect of the tariff. However, the economy, in the second half of 2026, inflation should gradually drift downward towards the Fed 2% target as we continue to adjust to some of these new norms. The Fed may only cut once this year due to elevated inflation, but could cut more in 2026. In September, the Federal Reserve resumed its easing cycle, cutting the Fed funds rate by 0.25% to a range of 4 to 4.25. We expect them to cut twice more in the fourth quarter of this year and deliver 2 more cuts in the first half of 2026. In doing so, they will continue to point towards slowing employment growth and assert that monetary policy remains mildly restrictive, since the regard for neutral rate of interest is being somewhere close to 3%. However, in implementing this gradual easing, they may also be seen as caving to political pressure, since their own summary of economic projections shows that by the end of 2025, they expect inflation rate to be further above their 2% target. Then the unemployment rate will be relative to their 4.2% long run expectation. Once the Fed funds rate has been cut to a range of 3 to 3.25, we expect the Fed to go back on hold until the economy sees some further serious economic weakness or inflation dipping below 2%, neither of which we anticipate before 20 or 27. So we could see rates go down, savings rates, CD rates start to decline as the Fed cuts rates because inflation has come down. Mega cap US stocks still look expensive relative to the rest of the market. One glaring anomaly entering 2026 was the huge outperformance of the largest companies in the S&P, both in terms of earnings and the equity market gains. Much of this reflects the dominant market positions of US tech firms and a surge of interest in investment in artificial intelligence. That being said, in recent years, the stock market outperformance of these companies has generally outpaced their outperformance in earnings, leaving their valuations at high levels relative to the rest of the market. Despite huge market volatility in the spring, this anomaly persists today, with the top 10 companies in the S&P representing only roughly about 40% of the market value for the entire index. So 10 companies accounting about 40% of the market of the value of the S&P 500. That's insane. For long-term investors, it may make sense to increase allocation to other areas of financial markets in case of economic, geopolitical, idiosyncratic forces turn on mega caps and U.S. equity, boom, starts to slow. What's also interesting, as you can see, the top 10 companies are accounting for about 32%, 32.5% of the earnings. But again, they're getting credit for about 40% of the weight of the S&P. So there's definitely a disconnect there. Bond yields, they look close to fair value, arguing for a neutral allocation. A resumption of Fed easing and signs of weaker labor market have allowed long-term interest rates to drift down in recent months, even as inflation has gradually increased. From here, however, we expect long-term rates to remain range-bound as the effects of the continued economic slowdown are counteracted by increased Treasury issuance in the wake of the passage of the One Big Beautiful Bill and tariff-related inflation. For investors, there's not a strong argument for making a bet on either side of the duration or credit in bonds. Even if the economy weakens further, any rally in bonds should be limited to by rising federal borrowing and stubborn inflation. Moreover, at least in the short run, we expect the economy to avoid recession, partially justifying today's tight credit spreads. However, we do think that roughly normal bond allocations make sense in this environment. Historically, today's close, around 4.3% on the 10-year bond, with close to 4.3% on a 5-year period. So that's kind of the expectations for bonds looking forward. Usually the starting rate indicates what your returns will be over the next 5 years or so. And so we can, pencil in maybe 4.3% return from bond allocation over the next 5 years. The dollar should drift down to slow the U.S. growth and portfolio rebalancing. The dollar has fallen sharply since the start of this year, maybe in part because high valuations, it was overvalued perhaps going into the year, and America's chronic trade deficits. However, it could also be the result of questions among both U.S. and international investors about their concentration in U.S. assets and the policies of the new U.S. administration. A key driver of the dollar in the long run has been that higher interest rates offered on U.S. debt compared to other domestic market economies. As the Federal Reserve cuts more aggressively than other central banks in the months ahead, we believe this narrowing in interest rate spreads, combined with still high trade deficits, could lead to further dollar decline. Which, as the dollar weakens, that can be positive for international stocks, and international stocks still look cheap relative to U.S. markets. So far in 2025, international stocks have sharply outperformed U.S. counterparts, as local currency outperformance has been amplified by the impact of the falling dollar, like I mentioned. Given this dramatic outperformance, many investors may be wondering if they have missed the boat on increasing international allocations. We don't believe so for 3 reasons. First, as we show you in this chart, even after a 2025 rally, non-U.S. equities still carry much lower valuations than their U.S. counterparts. So you can see here, much higher than average value, close to average, a little bit higher, close to average, a little bit higher, but not quite to the extreme of what the U.S. is. And third, given the outperformance of U.S. stocks over the last decade, most U.S. investors are likely very underweight international stocks relative to the appropriate long-term allocation. So some reason to be optimistic international. So parts of the stock market seem to be overvalued, but there's certainly pockets within the market that show fair value or even good value to find opportunities to make some nice returns. Alternative investments can provide a total return, income, and diversification. The last few years have seen strong stock market gains. However, that very outperformance could limit future returns. Moreover, the traditional role that bonds play in a zagging when stock zig has been challenged in recent years by higher inflation, which negatively impacts both stocks and bonds. In this environment, many investors are exploring alternative assets such as private equity, private credit, infrastructure, real estate, buffered investments. These assets are all quite different. Some provide strong long run returns. Some generate good income. Some act as a diversifier or downside protector. Many of them are quite illiquid and should be thought of for long-term investments, and the performance of different assets within the alternative space has varied considerably depending on the manager. Still, adding alternatives to a traditional stock and bond portfolio might make sense for many investors in this current market environment, and as we look at the continued growth opportunities for growth in the years ahead. Portfolio drift may have left many investors overweight the most expensive assets, and this is a conversation we're having with a lot of clients. Is it is to consider not just economic fundamentals and valuations, but how investors are positioned. The last 5 or 6 years, while filled with dramatic and difficult national and global events, have also, on balance, seen very strong investment gains. However, these gains have been by no means even. And so you can see here that we're seeing a lot of drift in people's portfolios that maybe they wanted to be 40% in stock or in bonds and fixed income here, but because of their strong stock outperformance, those values have grown so much that now they're much more out of balance, that if we did see a big decline in the market, this investor with only 25% in fixed income, where they thought they were maybe 40% in fixed income, could have a rude awakening. So for many investors, as we enter the fourth quarter of 2025, it makes sense to gradually rebalance, add diversification to the portfolio, particularly if this can be done in a tax-efficient manner. So always keep that in mind, because it's not what's happened or what's in the rear view mirror that matters, it's what's in the windshield that matters. And so we're looking forward, looking at different valuations of sectors of the market that have done very well, but could be more limited going forward. And then again, we want to make sure that your portfolios aren't too far out over their skis. So hope you found this information interesting and informative. Again, thanks everybody for watching. We wish you a great week, and certainly reach out to us if we can be of service to you and helping you preserve and grow your family's wealth.